Welcome everybody here to our next webinar at JFD Bank, and a warm welcome in the name of JFD Bank as well. My name Stefan Friedrichowski, as always, for those kind of webinars, and now I see there's something missing on my first slide. My name. Okay, but at least I mentioned it. I think on my summary page, I will have my email address once again. But nevertheless, it should be already mentioned with my really complicated last name, s.friedrichowski@jfdbank.com. Later, you will see we will have an Excel sheet, and if you have interest in that, no problem. Just drop me a note if you would like to have the slides of today's webinar. Once again, same thing. Just send me an email and I will make sure that you get everything. Okay, today we have the 31st of October 2019, 6 o'clock p.m., at least in Germany. And honestly, it's a little bit curious, or not curious, it's a little bit strange that I'm at 6. But you might imagine it has just been a mistake, or not really a mistake, because all webinars are based on GMT, and since we don't have summertime anymore, so therefore my originally target was 7, but now because of the different summer-winter adjustment, it's today at 6. But I think if we just follow our calendar and the entries after registration, then we are directly at the right timetable. So I hope everybody found it right. At least those who are here already definitely press the button at the right time. Today's webinar, Profitable Pair Trading Strategy. And you see later, as already mentioned, we will mainly talk about Brent versus WTI oil. So two kind of oils. And therefore, you see already why it's called pair trading, because we trade a pair of symbols. But there are other names in place for that kind of trading approach as well. Some call it swap trading. I don't know even really why, because for me swaps are just related to swap costs. But anyhow, or it's called ratio trades, which is a little bit more good here, because later you will see we will exactly look for the ratio of those two prices, those two symbols, and we will calculate the quotient of the two. So therefore, ratio trading is a good name for me as well. But anyhow, so we talk about trading a pair of symbols. But it's not just any two pairs. So we don't trade the euro US dollar against the German DAX. Or no, there's a systematic behind what kind of pairs are potential candidates for those kind of strategies, and that's exactly topic of today. Basically, you will learn a complete trading strategy during the webinar, and but it's more, as always, I want to give you insight into how a trading strategy is developed and how it's developed, and how you can really do things by your own. And that's always my personal target about that. Before I really start, I have always to show at least once during a webinar this kind of slide, as a so-called risk disclaimer, because we talk about trading strategies, investment trades, you name it. But finally, if it comes to your own trading, of course, it's on your own responsibility. I think that's quite self-explaining, and as you know, it has to be mentioned. Anyhow, I we'll skip the other one. What we really need is this one. The definition of pair trading. I will go into more details than mentioned already in my introduction. But then we really have to talk about the let's call it the requirements for that kind of strategy and what we are really doing. So it's more a description of the trading setup. And there's one really not complicated step, but a very important step in doing any pair trading strategy, that is finding the right lot size, because we trade two symbols, but we have a specific logic behind, which is the overall trade should be market neutral. But then it's important to get that condition really implemented, and therefore we have to really look into the details of the lot size calculations for the two trades we finally will open. And so that's quite an important step. Otherwise, we are not market neutral, and that is one aspect of pair trading strategies at all, which is some basis of that kind of strategy. We will look into a specific Excel sheet which is used for that kind of pair trading strategy. And the other good thing is you might even exchange the two symbols by other two symbols and try other pair trading strategies by your own. And I'll mention a few which might be a good idea to have a follow up on those as well. So the definition, or the really base assumption about any pair trading strategy, is that we trade two markets or two underlyings, two symbols, you name it, and we trade those simultaneously. So we open two trades, and it's always that we open the one as a long trade and the other as a short trade. So that's the basic approach. And you might think, hey, isn't that a little bit strange? Sounds like let's focus virtually on one market. Sounds like I open a long trade on DAX and a short trade on DAX simultaneously. That doesn't sound good. The only one who would be happy about that kind of approach would be the broker, because for both trades, the broker would earn the spread and the commission. And whatever the market is doing, going up or north, you will not earn anything, at least if you open the two trades with equal lot size. Just a virtual experiment about opening a DAX long and a DAX short, maybe both with two lots. So the only one who would be happy is the broker. And whatever the market is doing, you will not earn a single cent. That's quite obvious. But for two pairs, okay, for two different markets, it's a little bit different. Let's do a virtual experiment, another one. Let's think about we are trading the DAX as an index. We can trade that at JFD, and we would trade simultaneously the so-called FDAX, the future on the DAX. And there might be situations that trading DAX maybe long and the FDAX short, there might be special situations that might be profitable. And there's already a name for that kind of approach, which is called the how to pronounce it, arbitrage. I'm not sure about the pronunciation of that word, but anyhow, I will highlight it and you will see it here. It's exactly that. In principle, the DAX index and the FDAX should follow with an offset. The offset depends simply on the time between two to every 3 months, 2 points of time. But there's a constant offset which is decreasing over time. But anyhow, in principle, the two DAX and FDAX would follow exactly the same line. But think about, they would differ. If you're fast enough, you know that the two will come together once again. Then this long and short approach might be a quite good idea. Practically, nobody of us can do it. You can only do it if you have your trading computer as close as possible to any stock exchange. You need really to be quite fast for that. So doing something similar, and I mentioned already one potential pair like Brent and WTI oil, and not looking for something on milliseconds, maybe looking for something which takes place over a couple of days, then it's a similar approach like DAX, FDAX, or S&P 500 and the so-called ES Mini, which is a future on S&P 500. That might be the arbitrage trading for small traders like us. Okay, and the reason, and think again about my example, the reason that this might work is that we look for short-term inefficiencies of those two symbols. And there are even quite good stories when those inefficiencies might occur, and we can use those trading approaches for profitable trades by our own. And we don't need to do it on millisecond level. Definitely, answer is no. The setup of a pair trade is always that we look for a market neutral trade, which means that we just want to catch up small inefficiencies. But overall, if the market, think about the DAX or think about the price of oil, goes up or down, that is not our target of that kind of strategy. No, our target is that this kind of inefficiency would be recovered and not the overall trend. And therefore, this long short approach, the overall market direction, we simply don't care, and we will even not see it in our trade. So the basic requirement about any pair trading strategy is that we need two highly correlated markets. It's quite obvious if I think about the DAX index and the FDAX future, that those are really highly correlated, definitely. But those inefficiencies between those two, they are only visible on millisecond level or maybe on seconds, but not longer. So cost of trading would not be, at least for private one, not possible to catch up those kind of differences. But if we have inefficiency on a little bit longer time scale, and it best would be on a couple of days, yeah, then it's really perfect. And let me give you an example of and I mentioned already that we will focus on the two oils, Brent and WTI. And what you can see here is over close to 17 years, you see the price of those two symbols, WTI and Brent. And there are even times you could not even distinguish in my graph between the two. There was one period here for 3 years. You see more or less there's an offset between the two, and later that offset has totally recovered. So that would be an inefficiency on a real long term, but that's not the one we are heading for. Let's first start with the overall. What we can see definitely is the price of the two oils are more or less the same. There's always a small offset over a long period of time. Here in this decade, always WTI was a little bit more expensive than the other one, and if we look at the end of that graph, it's vice versa. But anyhow, in general, those two have, let's say, the same price or with a close to constant offset. But now, what if one is temporarily, let's say, getting more expensive and the other one would get cheaper. So let's assume the price at some point in time, and you see we are here looking for 2 decades, but the price for WTI would increase and the price for Brent would decrease. Okay, doesn't happen that often, but it might happen. But what will be the reaction of the overall market if that would be for a couple of days, couple of even weeks, or couple of months, that one oil is getting more expensive and expensive and expensive, and the other one would be cheaper and cheaper and cheaper. Since most of the industry can use both types of oil, they would simply buy the other one. So if one is getting cheaper and cheaper and cheaper, everybody would jump on that oil and buying only that and not anymore the other one, which is getting more expensive, more expensive, more expensive. What will the market do? Okay, the one which has become more cheap is now getting more expensive because everybody's jumping on that sort of oil. What will happen? The price of the two kind of oils will converge to each other. So they will, the price difference is getting smaller and smaller and smaller. So whenever there's on one time the gap between the two prices would increase, the standard market reaction of that increased difference would be to equalize that gap, or not that gap, that the price difference, because the industry can simply buy the other one. So and therefore it's never possible that only one can for long term get more expensive and the other for long term gets cheaper and cheaper and cheaper. There have been special reasons for those 3 years here, but you see, in general, the two prices follow the same line. And now, let me rephrase what we have had on the last slide. I called it on my last slide inefficiencies. And that's exactly what I'm talking here. So if temporarily one oil is getting too expensive, then it must go the other way around. The only question is now, how can we realize that we have a special situation of that market inefficiency? But let's see. There's a clear definition for that, and we will find out. Just another example. You see here in that chart the S&P 500 and the Dow Jones since 2000 for about 17 years. Besides that, we have a huge offset between the two, and that's one of the reasons why I used a logarithmic scale on the y-axis here. Honestly, would you know if I don't have the numbers here, which one is which? Okay, we all know that the Dow Jones is in numbers higher than the S&P 500, but let's think about, I would have normalized the chart. Could you distinguish between S&P 500 and Dow Jones? I think the answer is no. So overall, the two follow the same line, beside a constant offset. In this case, the offset is not an offset, it's a factor. That's all. So we can think about Dow Jones and S&P 500 as two correlated markets as well. We all know that it's not really markets. It's both S&P 500 and Dow Jones are just a selection of United States stock companies. The S&P 500, there are 500 companies creating the S&P 500. And the Dow Jones, yeah, there are 30 companies which, let's call it, if we add them up, that gives the Dow Jones, more or less. It's not really adding up, but you know what I mean. Okay, and now why we do have that kind of correlation. Okay, both is US markets. In principle, we could think about that the selection of the 30 might behave different than the selection of the 500. But can you think that for 1 year, like financial crisis, one goes down and the other one would go up? That would be a crazy situation. So highly correlated markets. And therefore, this is another good example to use it as a base for a pair trading strategy. I mentioned already that we can see within that chart, we have the Dow Jones in the red and the S&P 500. There's a more or less constant factor between the two, which in the logarithmic scale is a constant offset. Hey, then let's create that quotient. Therefore, the other name for the strategy, ratio strategy. So we have here S&P 500 divided by Dow Jones. Therefore, we have numbers which are close to 0.11, 0.12. So it's about a factor of 8, 9, something like that between the two. And now we have a more clear picture about what I mean with they follow the same line. Let's think just on a long-term behavior. And let's set up virtually a line like 0.11 as being, assuming that is the real and good ratio between the two, S&P 500 and Dow Jones. And now you can see already how the strategy would work. When we are highly deviated on one side of that, let's call it the fair ratio, just for next couple of minutes here, the 0.11. If we are far away from that standard ratio, that's a trigger that we would open up our pair trade. And the too expensive one, we open a short, and the too cheap one, we open a long trade. And the only thing now, from now onwards, is whether the market goes up or down. We don't care because we have a market neutral trade between the two, and therefore, whether there's a financial crisis, yes or no, we don't care. The only thing which matters is that ratio comes back to its normal value. And if so, we have a perfect and profitable trade without any additional market risk. Even a financial crisis would not have an impact on our trade. So that's quite cool. But now, what is the downside? Is there a risk? Yes, there's a risk. Let's assume that we open the trade on an almost, in the historical chart, perfect point in time for about here, that 2006. If that ratio would have increased, then we would have lost money more and more and more. So if the assumption that we go back to the fair value is not right, then of course we have a trade which will just create losses and losses and losses. But if we have the situation, and we will look not that long term anymore when we come to the final trading strategy, then it really works. But that's a basic thing. We create that ratio, and here we have the same picture for Brent and WTI, and here you can see for long term, that was a little bit above, the ratio was a little bit above 1, let's say for this decade, and then it's below 1 for that decade. So to use the 1 as a fair value, that will not work. We want to have that kind of strategy a little bit more on short term. So a couple of days should be our trading time, and not just years. So within that wiggling around, we should find our potentials. And you see, the ratio here is really getting up and down. We can't see it really without zooming into that chart. But what we see is that we have some kind of oscillating behavior of that ratio. And if we could use those ups and downs as a start and end for pair trading, for a pair trade, then this might be something really good. And that's what we are really heading for. So what is a trading approach? What we will use is just one additional idea. So instead of looking like virtually to a virtual value like 0.11 for Dow Jones and S&P 500 as being the fair value of that ratio, or the about 1 on a long term for Brent and WTI, let's create that fair value simply with an EMA in that ratio. Why not using just an EMA for the ratio? We are used to have EMAs on price charts, like whatever. Even in euro, US dollar, we can use an EMA as a trend filter or whatever. Let's just use that EMA on the ratio as being the fair value. So, and now strategy is more or less already completely described, not numbers, but from its characteristics. If we are far away from the ratio, that's a good thing. Then we are not talking about a single symbol. No, we are talking about the ratio. If that ratio deviates by far, and we have to define what is by far compared to the EMA, then we know we have a special situation. Oh, not wir, that's German. We have a special situation now. And that's exactly what I showed already a little bit in my chart. We have later better examples. If we have such a special situation that the actual ratio is deviating from the EMA on that ratio, then we have an extreme situation, which means one is very expensive and the other one is cheap compared to the ratio. And the logic for what short and what long is sometimes a little bit tricky, I know. But if you think more in terms like expensive and cheap, then you know exactly what you have to trade short and what you have to trade long. Of course, the one which is too expensive compared to the other one, this one is traded short, and the other one, the too cheap one, is traded long, because we target that the ratio will come back to its normal value. And then, yeah, that is the exact direction we need for the too expensive and the too cheap one. So the ratio should return to its normal value, which in more chart behavior means that the ratio of the EMA crosses zero once again. You will see later in my chart what I really mean with that. So in principle, it's a mean reversion strategy on a ratio. That's all. And let me just, because if you are sometimes in my webinars, if I would simply say we have a mean reversion strategy on a forex pair, it's exactly the same. Now you see, I mentioned on a forex pair because we cannot trade euro, we cannot trade US dollar. What we can trade is euro US dollar, which is a quotient of those two currencies. So a mean reversion strategy on a forex pair is exactly the same than a ratio strategy on Brent WTI. The only thing is there's no direct symbol for that. So if JFD or any other broker would offer the symbol Brent divided by WTI, then I could make the same kind of webinar and describe the same strategy. The only difference is I would call that strategy not a pair trading strategy. I would call it a mean reversion strategy. So you see, it's exactly the same. The only thing is we don't have such a symbol like Brent divided by WTI or Dow Jones divided by S&P 500. If so, then it would be a mean reversion strategy and we would do exactly the same. So you see the kind of similarities really quite obvious. The other good thing overall is in this case the overall market. We don't care. Think about Dow Jones and S&P 500, then it's more easy to realize what I mean with market neutrality. And that's exactly what we have to introduce here as well, because finally we want to open two trades, but those two trades have to be market neutral. And it's not just, and therefore I go here for the example S&P 500 and Dow Jones. You know that the two prices are totally different by about a factor of 9 or 8. So we all know that if I trade one lot S&P 500, and that this is completely different like trading one lot Dow Jones. You may think, hey, isn't it about the same? For both, it's 1 point is $1. In this case, because of dollars. No, it's not the same. They have different prices. So think about earnings. Like both go. You have two. You go for two long trades, S&P 500 and Dow Jones. You open one lot trade for both, and now I have to think more in percent. So if both would increase the price by 10%, then definitely you would earn much more with your one lot long Dow Jones. Because if the Dow Jones goes up by 10%, that would be a couple of 1,000 points, which is perfect if you have such a trade. But so you would earn much more because the Dow Jones is more expensive. On the other hand, I know what you think. It's not the same number. Yes, you're right. So we would have to use more lots for the S&P 500 trade, and then thinking about in margins or in risk, then you know quite well what I mean. So how can we adjust the two trades that we get them market neutral if we want to go short on S&P 500 and long on Dow Jones? And the final answer is just that equation, but let me just use in this case that equation because that gives you directly the number of lots. You only have to set the lots for one and you get the lots for the other one. Since the trade should be market neutral, we can simply multiply the number of lots with price of product A, and that should equal the number of lots of product B and the price of product B. Think about Dow Jones and S&P 500, then I hope it becomes quite obvious. So we would have to pay to buy about 9 times more lots for an S&P 500 trade than the Dow Jones. So it's exactly the ratio between the two. If so, let's think about that factor of 9. Then, if it's exact the factor of 9 between the two prices, S&P 500 and Dow Jones, and we open then now 9 lots short S&P 500 and 1 lot long Dow Jones. If nothing goes wrong with that kind of ratio, if the market get collapsed in the next crisis, we would not see, because then, for example, the S&P 500 would go down by 10% and the Dow Jones would go down by 10%. But since our trade is market neutral, we would not earn and not lose anything. But that was not the target. It's only that the trade is market neutral. The really point, the good point is we open the trade just when we have such an extreme situation. And now I will show you an Excel sheet, and then you can see how the strategy is, for example, if you really developed. And let me first enlarge a little here a little bit. I just want you I want to guide you quickly through that Excel sheet. If you are interested in really the details, you can have it, and no problem, just send me an email. But for all the others, it might be not that interesting for everybody if I go really into the details of the Excel sheet. Anyhow, what I have here is I started with the two prices, WTI and Brent. So within we have both prices here in the table, and the only thing you have really to care if you create such an Excel sheet is that you have really always the same date for the two symbols, because you download the data somewhere, and maybe one of those price series have just an additional day, the other has not. So then they are not anymore synchronized, the two series. So that's really thing you have to care. Then it's quite easy. Building the ratio of the two, creating an EMA on that ratio, and now just subtract them. So ratio minus the EML value, starting with a 0 here. So then we have the deviation between the actual ratio and the EMA. And if we have some certain threshold, which is in this case just a 1.1, we get a trigger for a trade. Let me explain it a little bit more. That curve here we have had already more or less because that was a ratio, but now we have that ratio with an EMA. And let me just change the EMA period, then it becomes a little bit more obvious what I mean if we have special situations. So you think, let me even go further up with the EMA. So the extreme situation that we have huge deviations of the actual ratio and the EMA, you can already see now here with your blanket eyes. And let me zoom in to one case first, because then it's just the beginning of the graph. It's the same graph, but only the first 190 days. I hope it will stop now. Yeah, now it's stopped. So we have the EMA, and now you can see those extreme situations. So we have a deviation of more than 5% between the actual EMA and the actual ratio and the EMA on that ratio. You see that difference. And the ratio comes back. So if you would have opened our market neutral trade here and we cross the EMA line once again on that ratio, that would be the trigger for closing the trade. We have a profitable trade per definition. And we open the trade as a market neutral trade. That's really cool. And that's exactly how the strategy works. And let me see, I have even built that graph here. So now the next step was building the difference between the actual EMA and the EMA, which is plotted here. And I think I have the same zoomed once again in the next one. And then we are here. So here we have just for a few days, and now I went for the last 180 days here. No, it's not really the last one. Oh, hopefully it stops now. I'm not still pressing any. Now I go back here. So it's just another case here, 180 days. And you see what really means if we look for the difference between the ratio and the EMA, that we can see those huge deviations. And now we have those through threshold lines, which we might use for automatically analyzing that kind of trading strategy. Think about we would use the 0.02 plus minus. Okay, then first time we would have opened a trade would be here, because if we exceed that threshold, so we open our pair trade, then we wait for crossing the zero line once again, and that would be the ending point of any trade. First trade. Then we would have opened the vice versa trading direction for the two symbols and closing. Opening the next trade would be here, and now we would be for a couple of days in the minus, because if the ratio goes up and up and up, we are on a losing situation. But you see what happens finally. We come back here. And then we, not in all cases, we get profitable trades. That depends on some further details. But that's the complete strategy. And now let's have a view on what we can earn percentage-wise. And you can even play with that kind of Excel sheet if you want to. You can play with the two marked fields, and with the EMA period, and the other one is here just a threshold. In this case, the threshold is not programmed in terms like I described it at the graph, like 0.02. It's just a multiple. It's a multiple on the standard deviation. But anyhow, that's not really important. Those two parameters are the degrees of freedom of that strategy, and we don't have any anymore. It's just the EMA period and the threshold. And the threshold here in my case is as a multiple of the standard deviation of the difference, but that's only for mathematical reasons. I first have here the trades in percent, because it's easier to calculate. And what we have, in this case, we have 100 trades with those two numbers, 105 trades. And we have the individual equity for the Brent and the WTI. And but the individual equity doesn't count. What we really want to have is the sum. And this one is the yellow line. And you see, we get a steady line going north. Hey, it's not that bad. And I have already included the spread, because if I would not include any spread of the two, we would even earn more money. So But anyhow, we have to pay the spread, therefore it should be included. But I know that nobody is really interested in earning some percentage numbers. No, we want to translate those trades into real dollars as well. I did it within the Excel sheet because 1 point is the $100. I used the market neutral condition. Even I applied what is the minimum lot size, and in order to calculate the lot sizes to get it at least as close to market neutral as we are. And let's have a view on what would be the latest combination would be like 0.9 and 0.8 lots in order to reflect that there is a price difference. We could use some other numbers here, then it would increase, no decrease. Then we would have bigger trades at all. It's just a multiple on all trades. And we would be a little bit more exact in order to reflect the different prices. Now we would buy 18.2 lots for the one and 16.7 for the other. And but the overall risk would be higher, and so on and so forth. So the Excel sheet can even calculate real trades out of that kind of strategy. If you see such division by zero, and that's okay because we don't have a trade here. So first trades would start when we have an entry. So here you see we have entries for trades, we have exits for trades, and everything is taken care of within the Excel sheet. If you have questions, just send me a line. So first you will get the Excel sheet, and if you don't understand something, no problem. I will help you with the Excel sheet. But you can see what we can achieve with such a simple strategy. And let me change the numbers once again. Smaller EMAs, now we see, okay, we get more percentage. So we have more trades, we have more profits, but unfortunately it went south here. Let me see, that looks a little bit better. We have now in some more profits. We have still 277 trades within that timeline here. That's about 20 years. So it's a little bit more than 10 trades a year. Well, not that bad. So it's strategy. We don't in trades that often, just for a couple of days. And then we go out and wait for the next extreme situation. And honestly, you could see those extreme situations even if you look directly to the two prices of WTI and Brent. You just only have to plot them next to each other, even better above each other. Then you can see whenever you have the situation like one has a a green candle and the other one has a red candle, that you more or less are directly close to an extreme situation, and then you can trade it quite manually and not that automatic here. But that's a complete strategy. It's really quite easy. Let me give you some hints how you can use same kind of strategy for other symbols as well. This was WTI and Brent, but as you might remember, I mentioned already the base requirement. The basis requirement is that we have highly correlated markets, and you might have even what I call a story behind. I mentioned the story behind Brent and WTI because you can use, not everybody can use these two sorts of oil simultaneously, but more or less. If one is getting too expensive, everybody would buy the other one. So that's just a standard market behavior. So that's a real good story. We have a similar story on S&P 500 and Dow Jones, but this story is not as good as the Brent WTI story. Why? Since Dow Jones has only 30 symbols, in principle it's possible that for whatever reason that kind of selection is just having the winners and or the losers. And the S&P 500 has, yeah, let's really say the average, because it's that huge, highly distributed, diversified, about 500 different symbols. So the story is not as good. Or we might use Pear gold and silver. So two metals are gold and platinum. Yes, story is not that bad. At least the latter one, like gold and platinum, is not that bad. Gold and silver, gold is two things. It's a little bit an industry product, but on the other hand, glossary, silver is more an industry product, so it's a little bit difficult. But there are other things like correlated stocks. Think about two companies like Bayer and BASF, or you take two car companies. For example, I'm a German, so let's think about German car companies like BMW and Daimler. So overall, they are operating in the car industry. Good. So if that kind of industry is behaving well, it will go up, and both will participate. BMW and Daimler. If the market goes down, okay, no problem. So that's okay, because we have always market neutral trades, so that story works. But temporarily, one might be better than the other, and then the other is catching up. Maybe the one is first introducing a new car, getting more attraction, whatever. That kind of story can be used as well. So that are highly correlated markets, and you can use the same Excel sheet for investigations of those pairs as well. That brings me already to the end of the webinar. So pair trading is really a good variant for any trading activities, and the real good thing is that we have those market neutral trades, so we don't participate in the overall market behavior. It's only those deviations between the two which trigger the trades. If we have an extreme situation that one of our two highly correlated markets is too expensive compared to the other one, that's a trigger, and that's starting a trade, and then we just hope for everything is getting to its normal situation once again, and then we have a profitable trade. That's the idea. On the other hand, it's just the mean reversion strategy. So if I would start everything on Forex, then I would call the same strategy mean reversion, because it's already something like a pair trade. Euro, US dollar, both are currencies, and we have the quotient, what we just call the exchange rate. So then it's a mean reversion strategy. So it's quite simple to derive, and even simple to implement that kind of strategy. And it only works if you have highly correlated markets, and they keep being correlated for a longer time. Then we can have that kind of successful trading approach. That's all. And here's my contact. S. Friedrichowski, really complicated last name, so just call me Stefan whenever you drop me a line. So s.friedrichowski@jftbank.com, and I will make sure that you get slides if you want, and if you want, you can have the Excel sheet as well. I hope you enjoyed the webinar. We have another one already in about 2 weeks. That's you will find on the internet and at JFD homepage. And the recordings of that webinar you will find from tomorrow onwards, as always, at the YouTube channel of JFD, and That's exactly the keyword. If you're just looking, just press at Google JFD and YouTube, and you will be directed exactly to the YouTube channel. You will find other recordings of any webinars there as well. Not only mine, from other speakers as well. Hope you see you again in 2 weeks. Enjoy your time. It's a little bit too early to say enjoy the weekend, but there's one day left. It's just a Friday. Okay. Have a good time. Bye bye.